Most businesses fail, but the question is, how can you have a business that doesn't fail? Hi, I'm Faizan. I'm an auditor, accountant turned entrepreneur. I'm the founder of Innovative Consulting, where we help businesses grow, be more cash efficient, be more tax efficient, and we help businesses save time, tax, and money. We researched various case studies and found one staggering reason because of which businesses fail, and this is all backed by data. A recent survey done by one of the UK's leading financial services institutions, Novuna, revealed that 31% of UK businesses fear closure by end of 2024. A recent study done by US Bank revealed that a staggering 82% of businesses fail because of poor cash flow management. Score.org, which is a resource partner of the US Wikipedia, did a study and revealed and their top reasons why small businesses fail is because of the fact that 82% of them experience cash flow problems. And not just that, we also researched businesses that were profitable but still went bankrupt. Sounds weird, right? We had a number of companies going bankrupt recently, both in the US and the UK. We had Carillion, a major UK construction giant. We had Toys R Us, a toy retail giant. We had Thomas Cook, the most famous UK holiday making company. And the list goes on. All of these companies were profitable in their books, yet they went bankrupt primarily due to, you guessed it right, cash flow management issues. What I'm trying to articulate is the fact that cash is king, and even if you have accounting profits in your books, you might still go bankrupt if you don't have the right cash flow management process in place. Cash flow management is the heartbeat of a business. It's about making sure that you have the cash to pay when you need it. It's about making sure that things run smoothly in your business. It's not just about tracking cash in and cash out of your business, but it's actually about mastering the timing of your finances. It's about making sure that you exactly know the amount of cash that is going to flow into your business, be it in the form of your existing contracts or those new customer conversations that you're having or that new technology that you're working on. So it shouldn't be for the next few weeks, for the next few months, but it should be for the next number of years. And it's about making sure that you exactly know the cash that is going to go out of your business, be it in the form of your bonus payments, employee payments, salaries, or that new machinery that you'll have to replace after 2 years, all of these things. If you don't have all of this laid out in front of you, and if you can't have a high-level 5-year view in front of you, trust me, you will be very lucky if you're going to survive. So cash management is about balancing all these cash inflows and outflows and making sure that you have a clear picture of your cash position over the next number of years so you're able to make the right informed financial decisions at the right time. You must be wondering, okay, Faizan, messing around with cash flows is not the best thing in the world to do, but it's such a broad term. So what are those things that lead to poor cash flow management? Poor financial management, this is the ultimate killer. It means not preparing meaningful, comprehensive budgets and forecasts that give you that high-level bird's eye view of your business over the next number of years in the long term of your business. And then having client concentration, which means your business is relying on very few clients, and if say one of them leaves, your business is on its knees. So if your business takes most of these boxes, then I may warn you that things might collapse before you even know. But don't worry, as they say, never lose hope. You can still turn things around in your business if you implement a proper system of cash flow management around your business. Now, of course, you must be wondering, okay, what are the major areas of cash flow management that each business must implement? So the first one is about forecasting for your future cash flow needs, and it's super important when it comes to managing your cash flows. It involves creating a budget, which means you sit down at the start of the year and what you do is you plan your expenses and you make sure that you allocate funds to all important activities of the business during the year. Then what's really crucial is during the year you perform an actual versus budget analysis. Why you do that? You do that because you need to make sure that things are going as you plan in your budget. And if there are any tweaks that are required to be made in your budget, you do that. Then the next very key area is forecasting your future cash flow needs. And what that means is you create a detailed, comprehensive cash flow forecast. What you do in that is you basically lay out all income that you're going to earn over the next number of years, and then you also estimate all the cash outflows, be it in the form of employee salaries or that new machinery that you have to replace, or that marketing expense that you need to incur given you're working on a new product. So all of that. So creating a forecast is really important, and it's really critical that you prepare a detailed, comprehensive forecast, because it ensures that you are prepared for your financial needs and you're prepared for any unexpected events in the future. And of course, just avoid any shortfalls. Next is about ensuring your business stays liquid at all times. And what that means is you maintain cash reserves. And what cash reserves do is they handle unexpected expenses or revenue downturns without disrupting operation. And if you want your business to be liquid, you balance your inflows and outflows, which means it's really critical that you ensure that the timings and amounts of your cash inflows align with what you have to pay in terms of your outflows. Okay, so next is accounts receivables and accounts payables. Now, managing accounts receivables means you keep track of the money that different customers owe you, and you make sure that they pay you on a timely basis. And then when it gets to accounts payables, it means you utilize your credit limits in an effective and efficient way. So overall, what I'm trying to say is you make sure that you have an aggressive approach towards getting your money from your customers. You make sure that you utilize those maximum credit period from all your vendors, so you keep that balance between cash in and cash out in terms of your payables and receivables. So next key element of cash flow management is controlling your fixed and variable costs, and not just controlling them, but actually knowing your fixed and variable costs. So what are fixed costs? So fixed costs are those costs which get incurred by the business irrespective of the level of activity, irrespective of the amount of revenue earned. They have to be incurred. They include costs like, say, amounts that a business spends on salaries, medical premiums, insurance, rents. All these costs are fixed costs. Now, in terms of assessing fixed cost, we would say that our fixed costs are too high if they eat up a large proportion of the revenue that the business has earned, or if they leave little room for profitability, or if they leave little room to cover the variable cost element of the business. Once we figure out that our fixed costs are too high, of course we have to do something about it. Like, we renegotiate contracts with our, say, landlords. We find more cost-effective ways to streamline our business processes. There's a lot of stuff that can be done to control the fixed elements of the cost. It's just about knowing the cost, and it's about knowing that you're incurring too much. Next is variable costs. So what are variable costs? Variable costs are those costs which align with the level of activity of the business, with the level of production, or with the amount of the revenue that a business earns. So we'd say variable costs are too high for a business if they increase significantly with the production activities, with the amount of revenue earned, but on the other hand, they don't boost profitability and the profit margins are still low. And when you conclude that your variable costs are on the higher end, again, you have to make sure that you renegotiate those raw material contracts with your suppliers. You renegotiate contracts with your subcontractors that are involved directly in the business activities, or streamlining business processes, finding cost-effective ways towards the production activities, and the list goes on. What I'm trying to say here is it's really important for a business to know their costs, especially their fixed and variable elements, and then it's really important to keep an eye on those costs and making sure that you take the appropriate actions required when you figure out that these costs are too high for the business. Next is optimizing inventory management, which means that the business needs to ensure that they are not holding excess inventory and the level of inventories are in line with their sales pattern. Because if you hold too much inventory in the business, it means too much cash is tied up within the business for no reason, which could be used for something else. So next is about utilizing financing options. And when it comes to finance, there's a whole world out there, but it's just about, from a cash flow management perspective, a business needs to ensure that it has access to credit facilities or it has access to loans when it requires, for example, in periods of business downturns, or for example, if there are any unexpected business expenses like in like a legal suit or any of these expenses. And then it kind of links back to the point around forecast that I discussed earlier, that if you forecast all of these expenses in advance, then the business might apply for these facilities in advance and then will have access to these credit facilities when it actually requires it. Then a business can utilize invoice factoring or invoice financing, where the business can sell their invoices to any third parties like banks at a discount. So as I said earlier, it's a whole world out there in terms of finance, but it's about making sure that the business has access to that cash flow when it actually requires. The timing is really, really critical. So next is about having that regular cash flow analysis and about reviewing your cash flow statements on a regular basis to understand where your money is coming in from and where it's going. And having those cash flow projections ready, again, links back to the points discussed around forecasts earlier. So you're on top of what you will be paying out and what you will be earning, both the cash inflows and outflows going forward. It really helps, and it's very, very critical for the business to have that analysis in place on a regular basis. I know it can be a lot to take in, but a financial expert can be a huge asset for any business owner who could help them understand the cash flows of the business. And not just that, they could really help you take key business decisions on a timely manner and in an efficient way so that your business is cash effective. This is where Finnovative Consulting can really help you out with their fractional CFO services, where you can get access to a wealth of knowledge by incurring a fraction of a cost instead of hiring a full-time expensive CFO. Well, I hope viewers, you now understand how critical cash flow management is for your business and the various different techniques that you can use to manage your cash flow effectively. We will cover these techniques in our upcoming videos one by one to help you understand what cash flow management is and why is it so critical for businesses to have a proper cash flow management process in place. I hope you loved this video, and if you did, please give it a thumbs up. And if you have any questions, please do drop your comments in the comment section below, and we'd love to engage with you.